Welcome to Biz Wire. I'm Joseph Nordstrom in Beijing. Oil tankers have been struggling to stay above water, even as the global economy seems to be showing signs of picking up. The two main trends changing oil shipments today are the increased demand from China, which is then countered by decreased shipments to the United States. Although oil consumption has increased this year, a recent report from RS Platou shows that global shipments of oil have fallen 3% in the first 5 months of the year. The fall is attributed to weak import growth from China due to last year's stockpiling and increased production in the U.S. These trends have combined to put a dent in tanker companies' revenue. On an annual basis, China's 2013 oil imports are unlikely to grow much from last year because in 2012, China continued to import more oil even while consumption growth fell due to lower economic growth. However, oil imports could rise further throughout the second half of this year, as the country is currently importing less than its long-term trend line. An analyst with Market Realist says higher industrial output driven by better outlook in China's largest trading partner, Europe, and Beijing's determination to maintain stable growth throughout the end of the year and meet its target of 7.5% economic growth adds to the probability of increased oil imports. If that's the case, this would be very welcome news to international tankers. Bloomberg News reported that companies like Frontline are booking at the lowest rates in more than a decade. Demand for tankers is down as China imports its smallest amount of oil from West Africa in at least 2 years. Bloomberg states that Chinese refiners will buy 28% less West African crude this month than a year earlier. Tanker owners are going through a 5th year of declining rates as fleet growth outpaces demand. Adding to this is that China has shifted to buying more oil from the Middle East, which is significantly closer than West Africa. ICAP Shipping estimates that the voyage to China from West Africa takes about 34 days compared with 20 days from the Middle East. Bloomberg says that China will buy nearly 300,000 fewer barrels of West African crude per day this month compared to last year. Analysts at BNP Paribas in London say that concern over unrest in the Middle East and North Africa could disrupt oil supplies and may encourage more stockpiling, boosting demand for more imports. However, the chief financial officer at Euronav, Hugo de Stoop, says that refineries in Asia may be out of service for extended periods due to upgrades which could curb some demand for oil. He says the downturn in the shipping market is all to do with oversupply, as there are just too many ships. China is favoring Russian and Middle Eastern supply over West Africa because of prices. West African oil is priced off of Brent, the North Sea benchmark, while Asian grades track Dubai crude, which has been trading up to $6 per barrel less. The U.S. is buying 12% less crude than a year ago as domestic production has risen to its highest level since 1989. This is changing the dynamics of global oil shipments, as before, tankers that took oil from the Middle East to the U.S. would then fill up in West Africa on the way to China. You're watching Biz Wire on the Blue Ocean Network. All of our stories can be seen on our website, BONTV/biz-wire. In just a second, we'll continue with more insight into the big picture of China's economy.